what's clear is that we have a pretty negative macro narrative going on, and without the recent flare-up in geopolitical tensions following the Iranian attacks, what we see is when those concerns diminish, those geopolitical concerns diminish, we rapidly fall back into the mid-70s. Hello, and welcome to this 8th episode of Oil Insights. I'm your host, Harry Tchilinguirian, Group Head of Research at Onyx Capital Group. And today I'm joined by Onyx Research Associates Vincent and Martha Dowding. Hello, guys. Before we start the show, please like and subscribe to the podcast. I invite you to also visit Onyx's LinkedIn and YouTube channels for more interesting and exciting content. Geopolitics has been the name of the game in oil markets over the past week, with oil briefly trading above $80 last week before retrenching into the mid-70s. The oil market is focused on Israel's next move when it comes to retaliating against Iran for the 1st of October missile attacks on its soil. Now, at the time of this podcast, front-month Brent is trading just around $74 per barrel, while backwardation in the prompt time spreads is holding around 30 cents. The latest positioning data show that money managers are getting a little longer on Brent, although perhaps conservatively, while the option market was pricing upside risk more expensive than downside risk, at least until yesterday. Looking at the 25 delta risk reversals, the implied volatility on 25 delta call options is about now the same as the one on their equivalent puts for the December 24 contract for Brent. All this because the Washington Post ran a story yesterday reporting that Benjamin Netanyahu told the Biden administration that he is willing to strike military rather than oil or nuclear targets in Iran. And this, according to two unnamed officials who reportedly are familiar with the matter, whatever that means. Now, before the stories, calls actually hit a premium of 11.8% above puts. However, risk premia vary and the market tries to assess the imminence of an Israeli attack. There's been much talk about hitting, obviously, Iranian oil infrastructure and the possibility of even hitting nuclear facilities. So the Washington Post story yesterday had quite the impact when it comes to pricing. Still, above and beyond that, we suspect that the U.S. has been holding back Israel's hand from a course of kinetic action that could lead to escalation and a wider regional conflict, especially as we have U.S. presidential elections just around the corner. Now, while geopolitical flare-ups lend support to oil prices, the negative macroeconomic narrative has not disappeared. It is likely why we have not yet sustained a move above $80 for Brent, and the market's focus has been particularly sharp on China and China's stimulus efforts to get its GDP growth to 5%. Now, despite substantial monetary easing, the market was really looking forward to guidance on future fiscal policy. And here, China fell short of expectations. Over the past weekend, announcements by the Ministry of Finance did not deliver a timeline or any figures when it came to government spending, and the market, was expecting some 2 to 3 trillion renminbi increase in the central government's deficit to finance economic growth. Now, the Ministry of Finance has promised more aid to the slumping property sector and also indebted local governments. Still, there were no measures announced relative to supporting consumption, this amid deflationary pressures that are affecting the economy. For 2025, we might get more clarity in December when the Central Economic Work Conference takes place, but until then, we'll just have to wait. A couple of episodes ago, we had professed that the 70s range was the new 80s for Brent, and guys, so far so good. We're still in the 70s. So much is going to, of course, depend on how the narrative unfolds in the Middle East going forward. Iran's 1st of October attacks on Israel are deemed to be different from those that were conducted back in April, both in terms of scope and weaponry used. They would, in theory, necessitate on the part of a more belligerent Israel a different kind of response. In the game of brinksmanship, there's always that risk that escalation could lead to miscalculation. So we'll just have to see how events fold out. Now, on the product side this week, we're going to be focusing on Naphtha, and in particular, we're going to be looking at recent pricing trends and whether these reflect the seasonality in terms of gasoline demand or the possibility of reduced feedstock demand from the petrochemical sector on account of a weaker economy. We'll also have a quick look at regional differences between Europe and Asia, and whether or not Asia will continue to trade at a firm premium to Europe when it comes to Naphtha. So let's get started. Vincent, we're going to be looking at some positioning data. Could you take us a little bit through some of the recent changes, at least as far as the data goes?
Yes, so for the money manager net position in Brent Futures, there was a significant change week on week. We saw one of the largest increases in net positioning in over 18 months. So we can imply that this was driven by geopolitics, especially given the timing. Of course, first you had the Chinese stimulus announcement, followed by Iran's retaliation against Israel and the potential for the Israeli retaliation. So for risk managers, money managers, it was prudent for them to perhaps cover their shorts, as well as for new speculative length to enter in anticipation of a potential response that would disrupt oil supply, oil infrastructure, or
Geopolitics was a true catalyst in terms of actually changes in positioning this time around.
Exactly, and all of that propelled flat price to above $80 for a brief period of time. However, of course, recently flat price came off again. So just as geopolitics was a huge factor for the bullish reversal, as these concerns deflated, oil also came off recently too.
So, I mean, obviously shorts were taken off, longs were added. The net position for money managers has increased on the Brent contract. But when we look at things from a long to short ratio perspective, have we really taken off?
Not particularly. So it's up to around 2.6 to 1 longs against shorts. So that's the 25th percentile for all weeks since 2013. So on a historical basis, still relatively bearish, but market was definitely not max short anymore. However, for positions to become even more bullish, that will be quite difficult, especially given the fact that geopolitical concerns are deflating, as well as the negative macro narrative surrounding China and Europe.
So I think, obviously we look at positioning on futures by money managers, but Onyx, of course, has its own assessment of CTA positionings. And I was wondering if the picture there just focused on this particular category of market participants, whether we're seeing the same amount of change, if I could put it that way.
So CTA net positioning had been rising quickly. So from the charts, it went from negative up till around flat position for Brent CDAs on 11th of October, and actually on Monday it flipped short once again. So it's quite likely a good amount of short covering flows came from CDAs. They were previously max short, but there's two trends we can see. The net positioning peaks in the last 2 years have been getting shorter and shorter. So if the peak is lower, then this means that CDAs might be getting increasingly bearish in crude oil futures. There's not deploying as much bullish positions in there, but also meaning that there is quite a lot of scope for CDAs to push crude higher or lower depending on either bullish or bearish catalyst. And recently, last night, that was a bearish catalyst. CDAs previously were relatively neutral, and that meant that they had more short positions to deploy, pushing prices down.
So I think we're probably seeing a little bit of a seesaw when it comes to positioning. Of course, the initial catalyst with the Iranian strikes. Now this news report by the Washington Post. It's amazing how sensitive positioning is to headlines. And we've seen this with headlines from articles from the FT and the Wall Street Journal recently pertaining to market share or price targets or supposed price targets. There is obviously a lot of hesitancy in the market. And given the price action that we had yesterday and the relatively abrupt loss, it may just be that some of the positioning was reversed. And by the time we get to Friday, we are likely to see possibly a different, I would say next Monday or next Friday, we probably are likely to see a very different set of data if the current trend prevails. Now, of course, we talk a lot about Brent and how Brent has moved, and I think it's always interesting, of course, to expand a little bit the horizon and just see what are the knock-on effects and how Brent, trades relative to other crude. So, I mean, we're quite active in trading Brent Dubai here at Onyx. So I thought it'd be interesting to cover a little bit how that spread has been behaving in the prompt. So what has become of the spread? I mean, amidst question marks around OPEC returning barrels, geopolitics, is the spread Brent driven or is it Dubai driven?
It seems to be more Brent driven from just from initial observations. There was as Brent crude flat price rallied up to $80. Spreads rallied as well, and this actually led the Brent Dubai spread to rally too. Saw a spike upwards, and this has actually been the trend in the past couple months as well. Whenever Brent spreads rally, that led to a rally, and Brent Dubai last week was no different. And so the M1 front month spreads rallied above $1 briefly, but over the past week that has come off slightly once again. So the strength it's relatively momentum driven by Brent. And the more deferred actually, so the Q1 2025, that is the strongest part of the curve, still above $1 at the time of recording, and we can interpret this as the time when the market probably anticipates the return of OPEC barrels. But turning to the very prompt, the Dubai physical continues to price strongly against the 2 months ahead. So for the last 2 months, we've been seeing the Bow month, the Bow box, so Bow set oct, and now Bow oct versus November, consistently below $0, below flat, and that's at minus 80 cents per barrel currently. So it implies that Dubai physical is pricing relatively strong against Brent. Onto the positioning though, the prevailing interest we've been seeing that the market has there's been a lot of selling interest after rallies in Brent Dubai. So each rally, which is driven by Brent spreads, people might see an opportunity to sell into these highs. So particularly, we've been seeing selling from trade houses and majors in November, as well as refiner selling. Interestingly, funds have been selling more in the back end Brent Dubai, so like the Q1 tenors.
So maybe the physical players have a better understanding of the relative supply actually on the market. So whenever you have the paper moving in that fashion, it becomes always an incentive to fade those rallies. And if Brent moves up against Dubai, well, and there's still quite a bit of supply around, then yeah, why not fade the rally? Well, this generally brings us to our crystal ball moment when it comes to crude oil prices. And so when looking at the Bloomberg terminal, the consensus for the average price in Q4 is circa $79 a barrel. That's sitting a little above the futures curve valuation right now, which obviously has come down overnight. Back in September, Bloomberg Intelligence had this survey, and 88% of its 176 respondents actually saw Brent being below $80 at the end of this year. Now, as always, the oil market has several moving parts. So between geopolitics, positioning, fundamentals, I mean, there's a lot to think about in terms of what could shape the direction of oil prices. On the fundamental side now, it's quite interesting. We had the release of the OPEC Secretariat's monthly oil market report yesterday. And this morning at 9 a.m. London, we had the release of the IEA report. Both reports remain entrenched in their views. OPEC barely shaved a smidge off its relatively hefty 2 million barrel a day growth forecast for 2024. Whereas the IEA this morning looking at oil demand growth just below 900 kbd, with further downward revisions to the demand of China. So, I mean, what can we expect for the end of the year? I mean, Martha, do you want to have a go first at how you feel about oil prices by the end of this year?
I think I struggle to feel optimistic about oil prices by the end of the year. I think looking at ending the year at $79.50 a barrel is quite optimistic. I think the drop we had this morning seems quite representative of the bulk of risk premium being dropped from the flat price. I think, of course, there's still some risk premium in the flat price because there's the extent to which the market does believe Netanyahu. There's, two sources unnamed, and the quote is that he will still do what he thinks is best for the national interest. So it's not a 100% commitment, so there will still be some risk premium. They're still fighting in Lebanon, so there still will be that geopolitical
Element,
thank you, in the flat price, which means there could be more to drop. Hopefully, touch wood, this is a de-escalation in the conflict, and we'll continue to keep seeing this. If this happens, we'll keep seeing that risk premium be chipped down and down. In the wider picture, China are determined to show the market that they're doing everything they can, but exports are down to a 5-month low, imports are also down, and the market just didn't believe the stimulus measures when they started. And I think unless they start coming out with something very different and something less almost superficial, less interested in boosting equities and more interested in boosting like the actual, deep
the real
rooted
economy.
issues, of the economy, I think that these kind of headlines may struggle to incite better positivity. And lastly, looking at the CTA and overall commitment of traders data that Vincent mentioned, looking at the products rather than the crude prices, there was a huge removal of short positions from money managers in gas oil, heating oil, and RBOB, so like across the barrel. So these players may well come back in, and that will affect margins, which could affect crude demand. And therefore, I am bearish.
Okay, well, Vincent, you've typically been our perennial bull. I'm surprised that you're not wearing your horns today. But are you as bullish as usual, or maybe are you nuancing your view a little bit?
Perhaps more nuancing. It's still some more tentative. We're not ready to put on the bullish horns just yet. Although if I was here last week, maybe you would have seen the horn on my head. But yes, so I completely agree that 70s is the new 80s. But if we're looking for bullish factors, then have to look at like OPEC pluses, whether or not the compensation plans come into fruition, which will affect the supply and demand balances, as well as the fact that global central banks have been entering an easing cycle, which more easy money could, in the later months, lead to more higher oil demand. Of course, as well as China's economy, this Friday there'll be a key GDP reading. So if that hits above expectations, if that goes above 5%, then the market could react positively, perhaps more stimulus measures in the future. So if that leads to a strong reaction from the equities market and risk assets, then this bullish flow could manifest in the oil markets as well. So I do believe that given the fact that the world's entering a monetary easing cycle, this could provide a floor for oil prices. We could also mention that OECD inventories are relatively low, I think at the lower end of the 5-year range. So that could be a bullish factor too, something to keep in mind about.
So we have a lot of cross currents when it comes to what is driving the oil price. I mean, when I look at it, I always sort of struggle with the concept of risk premium, because that sort of means that there's this perfect price that is the expression of fundamentals, and the difference between that price and what we're seeing on the screen is a risk premium, and a premium that we could like slice and dice and say, well, that amount is attributable to geopolitics, for example. But I mean, having said that, what's clear is that we have a pretty negative macro narrative going on, and without the recent flare-up in geopolitical tensions following the Iranian attacks, well, what we see is when those concerns diminish, those geopolitical concerns diminish, we rapidly fall back into the mid-70s. So I think our call for 70s being the new 80s is still a valid one for the balance of the year. I think what's also interesting is that I don't necessarily think that the oil price is going to crater into the 60s, or at least go down to the 60s and stay there, because there's a lot of bearish pundits as well. Let's not forget, oil inventories are extremely low, so that allows OPEC, should they choose by the end of the year, to distill back small amounts of supply into the market. I mean, at the end of the day, this may affect the shape of the curve, but in terms of flat price, given where these inventories are. And you reference the OECD industry stocks. Well, that's a metric that OPEC has often used in the past, publicly acknowledged tracking. So I would suspect that there's an element there, and that's the sort of element that could prevent prices from moving too high up if we don't have an actual supply disruption. China, also an important one. I think there is stimulus going on. How much of how much of it is really going to affect the real economy? How much is going to affect this financial sphere? We already saw the Chinese stocks rocketing upwards on monetary easing. The real economy is going to be a different matter, and we'll see if we get more fiscal guidance from China. So yeah, currently right now it could be a good opportunity for selling strangles on this market and picking up some premium along the way. Now turning to products and turning to Martha, our product of the week is Naphtha, right? And so basically, how has Naphtha behaved recently in Europe and Asia? And more importantly, I think from a crack perspective, which is something that for us is the sort of pathway to flat prices in Naphtha, how the cracks behaved. So what are you seeing in Naphtha?
In both regions, so in the NWE Naphtha in Europe and in the MOPJ Naphtha in Japan, which is where we focus our attention on, we've seen a pretty strong couple of weeks, month or so, looking at the historical prices. The M1 Naphtha crack in Europe is almost at its strongest level for this time of year. I think it's the second or third strongest year that it has been, back to like 2019, 2020, when we were seeing positive cracks, which we haven't seen since then, really. The Asian cracks are holding up well despite the move in crude, and they're stronger than Europe, which I think we'll get to more later. And after the Golden Week holiday, we've seen that buying come back and a bit of strength there. There's been a bit of softness this past week, but looking at the prices still as a whole, they're still really strong prices. The softness may be due to the softer petrochemical margins we've been seeing. Part of the strength may potentially be related to the tighter supply picture. Looking at the refineries, we've seen some refinery maintenance really across the world, with the crude build in the US last week showing that this has maybe begun. Outside of the US, where it is potentially more important for Naphtha, we've seen that a few Russian refineries offline earlier this month, which is stemming the exports from Russia into the Far East. And we're seeing this heavy maintenance in Russia starting again now, whispers of it. The flow into Asia is really important from the West, and particularly in the context of the geopolitical risk. Earlier this year, we saw this East-West be really affected by the TC5 freight rate, which is completely, this isn't the case anymore. It's kind of normalized at these heightened levels, geopolitical tension levels, I mean. But it's still really important looking at the Strait of Hormuz, and because that takes so much naphtha from Europe to Asia. So although this may not be the kind of headline part of the geopolitical risk currently, it's always something to be really aware of.
Yeah, no, I mean, it's certainly a very important passage. And when we say from Europe, we're obviously including Russian here. The Russian naphtha flows to Asia are quite important. Do we have a sense of who are the more active participants in terms of buying and selling the crack on the prompt?
Yeah, so looking at the Onyx positioning data, we can break it down by counterparty. So in both regions, we've seen really strong trade house selling in the cracks, and that's the only real similarity looking from the beginning of September in the counterparty positioning net in the prompt. But from late September, we've seen buying in the European crack from refiners, which is always quite an interesting flow to look at because this isn't their usual flow that they're doing, which is out of the ordinary. So this could potentially signal like the unwinding of some hedges ahead of more optimistic pricing in the future, just adjusting hedges generally, which is always something to keep an eye on. And that's been in decent size as well, which is interesting. But spec funds, funds who are like speculatively trading, they've been selling in the MOPJ cracks in Asia, so they see some downside at these levels. So yeah, some interesting pointers there from the counterparty types.
Okay, I mean, we talked about Europe, we talked about Asia. I guess the obvious lead-on question
Yeah.
is, what is the East-West spread doing, right?
Yes, so the East-West spread's been very strong. It's come off from the absolute tops, but remains very high. We're looking at the second highest naphtha prompt East-West for this time of year ever. And looking at these historical trends, last year we saw a pretty strong escalation into the end of the year. So it'll be interesting to see if that kind of plays out again as maybe once the market softens and rebalances, we could see that.
Okay. I mean, with NAFTA, of course, it's always a lot to do about, economics. So I guess the first question that comes to mind is the propane NAFTA differentials, because obviously they dictate, how at the margin the petrochemical demand for feedstock is going to behave. So does NAFTA have an advantage in one or the other region in terms of feedstock? How's the pricing between the two?
In Europe, propane is at a steep discount to naphtha, whereas in Asia, they're about similar. They're more similar to each other. So this kind of points to, in Asia, naphtha continuing to stay in the cracking pool, whereas Europe, the incentive to use naphtha over propane for producing these petrochemicals may be less desirable.
Okay. I mean, that certainly makes sense, and maybe that's also part of the reason driving the strength of the East-West spread. I mean, Asia is looking for naphtha, and Europe a little bit less. The other side, of course, of the economics picture for naphtha is gasoline, and whether we have an incentive of reforming naphtha into gasoline. So, how are the famous gas snap differentials doing?
Interestingly, so last month we had seen a really sparse market in the gas naphtha itself, and it was just kind of being moved around on its legs, so by gasoline and naphtha trading. But last week especially, we've seen more physical selling in the gas naphtha. So this is actually quite bullish for gasoline, which you wouldn't think looking at the flows, but it shows that there is real blending demand from these physical players. So this, we've seen especially heavy sellers from refiners who are selling the gas naphtha to hedge their blending demand, and also some ARB selling looking at gasoline, so the difference between RBOB and EBOB. So this may see some support from European gasoline from the American gasoline strength. And we've seen less flow, but still some flow of the Asian equivalent, which is the 92 MOPJ selling as well. So that's really interesting and something to keep an eye on, a bit more roundabout way of impacting naphtha, but it's important to look at.
I suppose, I mean, even as we hedge the differentials, and obviously that relates to blending demand, so you're locking in your differential there. All in all, still, I guess, relative to summer, I mean, we've come down a long way since the August highs for gasoline's premium over naphtha, and therefore the amount of reforming of naphtha into gasoline is probably going to be less. But I think what is at the end of the day quite interesting is the big difference between Asia and Europe on the petchem side, because having such a steep discount in propane versus naphtha in Europe and having nearly equivalent pricing between propane and naphtha in Asia is clearly the petrochemical sector in Asia is going to jump on the naphtha. So the steam crackers are going to run. Whereas perhaps in Europe, the PDH, plants are going to be the ones doing most of the work. So, I mean, with that on naphtha, we're getting to the end of our oil insights for this 8th episode. I was wondering if you guys had any particular thoughts or things that you're looking forward to this week. Any data points of interest? I don't know, Martha, do you want to kick us off?
Probably just to go back to the US and see, because they're the only real reliable stats, to see how much refinery maintenance we're seeing, and therefore we can keep an eye on the ARB to see how much gasoline is being locked in from Europe, and that impact as well. Crude weakness as well, the impact on the cracks. If we continue to see strong buying interest in the naphtha cracks, the weaker crude could allow this to, be amplified further.
Okay. Vincent, are your thoughts drifting east?
Drifting east, yes, but still back to China.
Seems that all roads lead to China in the oil market these days.
Yes, or roads lead to Beijing. Onto the diesel demand, actually, we saw figures that Chinese consumption in September is down 13% year on year for the month of September. So it's actually interesting because it's usually the strongest season for diesel consumption. The reasons that have been cited include the slumping real estate industry, as well as the substitution of more LNG powered trucks are being used for transportation purposes. For real estate, that's because less demand in terms of logistics, for example, construction equipment and machinery. So therefore, with all the stimulus hype, people focusing a lot on the headlines. So in addition to crude flat price, how can we see the impact in the oil market, which is through gas oil, through diesel demand, and we should therefore keep a close eye on the Asian gas oil structure. So that would be in terms of seeing 10 ppm spreads and diesel cracks.
Okay, so all this, when we get our Chinese GDP number, is going to be quite interesting in terms of the reaction of the industrial fuels and their pricing in the East, because if we're falling short of 5% economic growth target, then clearly there's going to be some movement when it comes to those industrial fuels. Well, with that, Vincent, Martha, thank you very much for joining me. Until our next episode, don't forget to smash that like button and, of course, subscribe. See you next time.